This is lesson 6 of the Seido Trading Learn to Trade series. Up to this point, you've learnt how to read price action, understand the conditions that produce momentum, and build a strategy around what you see. This lesson is about context, and specifically how to read higher timeframes and use them to guide your decision making before you ever look for an entry. When traders talk about context in a price action sense, they're referring to the price action on a higher timeframe. Every concept covered in the series exists on every timeframe. The candlestick behavior from lesson 1, momentum in lesson 2, and the trends and consolidation patterns we learnt in lessons 3 and 5. These are the price action principles we use to build our context. The highest time frame a pattern is visible on determines how long it takes to play out. A trading range on a daily chart can take days to break out. As a general rule, if a pattern looks large or confusing on the chart you're looking at it, switch to the higher time frame. This will give you the perspective you need to make an informed decision. This is a daily chart of platinum. I've loosely marked out the trading range with the grey box, and I've marked out some swing highs and lows for you. As a rule, price can fail a breakout attempt of a trading range, trend, or any other level within 5 bars on the highest time frame that structure is visible on. So I want you to pause the video for a moment and look at how price responded around the swings I've marked out, the swing highs and the swing lows. What you notice is that some of these took longer, correct? So you have to ask yourself, was this structure visible on a weekly chart? Pause the video again and look at the weekly chart of platinum and how price responded at these levels. This is why context matters before you do anything else. A valid signal on your execution time frame can still be a low probability trade, depending on where it sits within the higher time frame picture. Understanding that picture is what the rest of this lesson is about. As our understanding of price action develops, our ability to read context across multiple timeframes also develops. So it is best when you're starting to just pick one higher timeframe. With more than one, multiple timeframes can create what appear to be conflicting signals for beginners. For a developing trader, this creates hesitation, as we learnt previously. This leads to inconsistency and poor execution for traders. One higher time frame gives you a clean, usable perspective. What you're looking for are the identifiers of momentum, consolidation, and trading range price action. These are the fundamentals we built from lessons 1 and 2 and are your base for contextual understanding. This is where traders who have done the coursework will begin to see the rewards. If you've completed the lesson 5 coursework, you would have already started doing this. The consolidation patterns you were asked to look at from the higher time frame perspective, that was higher time frame context building. You were reading the higher time frame before this lesson gave it a name. Every time you look for context, ask yourself the following questions. Is there a trend or a trading range? Where are you within it? Are you early in a trend or are you late in a trend? Are you high or low in a trading range? What are the candles telling you at the level right now? Is the momentum strong or is it weak? This is also where the higher timeframe EMA tool we gave you for TradingView becomes useful. It gives you a quick visual read of higher timeframe bias without needing to switch charts. When price is sitting above the higher timeframe EMA, the bias is long. Below it, the bias is short. It is a simple, clean filter that keeps you aligned with the higher time frame perspective. This is a trading range candle. This is a trading range. And this is a trading range too. Traders have to imagine that this single candle structure on the higher time frame appears as this style of price action on a much lower time frame. Remember, price action is consistent across timeframes. All of these structures are the same, and traders will treat them as trading ranges, and therefore they'll buy low, sell high. Every trading range starts to attract buyers towards and below its low, and sellers towards and above its high. You learnt in the previous lesson that pullbacks after momentum are trading ranges, so they will attract traders who will want to buy low, sell high. This is fundamental trading range price action. This is context. It's understanding how traders respond when they see trading ranges or strong momentum. Here's an example. So the whole grey box is a trading range. It's a pullback. We established that in the last lesson. Traders are buying in the buy zone. Every individual trading range candlestick also has these zones. So pause the video for a moment and look at how traders responded around the highs and the lows of each of these candlesticks. When you're annotating your chart, this is what you want to spend time on, reading the behavior of market participants around the highs and the lows of candlesticks. This is what you've been building towards since lesson 1. At the higher time frame level, these structures carry more weight. They've got more accumulated, lower time frame traders. Understanding the higher time frame and applying it to lower time frame execution is what differentiates traders. There are 2 types of trades you can take: home runs, which feel great and are huge wins, and base hits, the trades that consistently build your account day to day. The difference between a good trader and a great one is being able to take base hits while at the same time knowing when to swing big. A trade in the middle of a higher time frame range is a base hit. A trade with higher time frame momentum and room to move, that's a potential home run. Higher time frame context is how traders know when to swing and when to take a base hit. Base hitting is not settling for less. Base hits are discipline, and they keep you in the game long enough to recognize when that home run is actually there. Without the higher time frame perspective, this looks like a good momentum play. A beginner trader may see the failure of the momentum to continue and not understand why. A trader who's looked at the higher time frame perspective understands that price is currently trading within a trading range, so they expect this trade to be a base hit and for it to find sellers near the high of the trading range. Here's another example from platinum. Price was in an extended trading range and then broke out strongly. It pulls back and forms this large consolidation. From the higher time frame perspective, we're late in a bull trend. We're also getting double inside bars late in a bull trend. If you remember from last lesson, I taught you double inside bars late in a trend are likely to break out in the direction of the trend, but then they're also likely to fail. This is exactly what happened here. The higher time frame perspective allowed traders to make informed decisions as to the likely outcome of the trade. Understanding context takes time to develop, so if you're overwhelmed, that's normal. The lesson has given you the framework, and the Price Action Mastery course covers these topics in a lot more detail. So take your time learning, ensuring you understand these concepts well. Your coursework is to continue marking up your charts, assessing individual candlesticks, trading ranges, and momentum with the higher time frame perspective in mind. Find a period on your higher time frame where momentum was clearly present. Drop to your execution time frame and observe what happened. What did the candles look like? Was there consolidation before the move? Where did pullbacks occur? And how did price behave around trading range candles within those pullbacks? Then find a period where the higher time frame showed a trading range and observe how price behaved at its highs and lows on the lower time frame. This is where the work from lessons 3 and 5 starts to really connect. The habit of marking up your charts is what builds your read of price action over time. When you're ready, start adding higher time frame filters to your strategy document. Step 8 is the spot for higher time frame conditions that disqualify a setup. Start with one clear condition and build it out from there. That's it for lesson 6. You now understand what higher time frame context is, how to read it, and why it shapes your expectations for each individual trade. The habit of checking the higher time frame before you look for an entry is one of the most valuable things you can build at this stage of your development. In the coming lessons, we will cover measured moves and how traders use these to exit trades. I'll see you there.